and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta, executive writer at CTMfile. Joining me today are Jack Large, editor of CTMfile, and Craig Jeffery, managing partner at Strategic Treasurer. Welcome back, Jack and Craig. This week, we are focusing on 5 themes, namely mergers and acquisitions in turbulent economic times, ESG and sustainability, investing, cloud computing and security risk, central bank digital currency, and FedNow via API connection. You can read these articles and also research content more deeply by visiting ctmfile.com or by following the links in our show notes. Our first theme for today is about mergers and acquisitions, or M&A, in turbulent economic times, lessons that can be learned from the last recession. Investing in M&A during an economic downturn or in times of economic turbulence may seem counterintuitive. The instinct is to halt deal activity or acquisitions, cut spending, and preserve cash. To understand the nature of M&A activity and its decision-making process, Bain & Company conducted a survey of nearly 300 M&A practitioners worldwide titled Global M&A Report 2023. The data in the report shows that companies that were engaged in deal-making activity or acquisitions during the last economic recession consistently outperformed those that stayed away from deals. Jack, if I may start with you, with regard to the findings of the Bain report, do you think CFOs and corporate treasury should take a leaf out of the recession book and pursue good value acquisitions in times of economic contraction?
I feel this report is ignoring the very nature of corporate treasury, that you can't change the composition and way of working of companies automatically because M&A might be attractive. Some industries naturally have incremental taking over of smaller companies, others don't. Having said that, corporate treasurers need always to be aware of the deal and the merger and acquisition opportunities, regardless of the nature of the company. It may well transform the company, but first you have to start with the nature of the company and whether it's naturally an M&A type company.
Push and Jack, when I think about the old adage, buy low, sell high, during times of economic troubles, this would be the ideal time to buy. Everyone says that, but the reality is it's very hard to do that, because it seems if the entire market is going down, that's a problem. So, thinking about kind of along the lines of Jack's comments, sentiment of, hey, we're positive doesn't equal reality. There are a lot of private equity firms. There's quite a bit of cash awash out there, both on the corporate balance sheets as well as with private equity firms. There are deals getting done, but it's I don't know that I would say that that's a key area of a lot of activity. There certainly are some deals getting done. They're being very selective. Mm-hmm. The rate rise is another headwind to that. So this may be a little bit more optimistic sentiment rather than action. Now, when we look at the use of technology, companies buying technology to improve their operations, that does not seem to have slowed really hardly at all, despite some of the headwinds and expectations of recession, either in pockets or perhaps dipping globally. So that hasn't slowed at all, and sometimes that's an early indicator. I know some tech firms are nervous that it may slow, but we haven't really seen that. The M&A deals are being more cautious during this time. But certainly worth reading the article.
Our next story is about more treasurers embracing ESG and sustainability investing. Treasury Spring, in partnership with ICD and the London Stock Exchange, recently distributed a survey report titled Sustainable Finance Survey 2022 that threw light on major ESG and sustainability-related trends in money markets. Through the survey, Treasury Spring observed that treasurers are generally keen to play their part in achieving the transition to net zero, utilizing all the tools at their disposal, including ESG investing, financing, and other initiatives. Jack, from a corporate treasury perspective, what, according to you, are the most important findings of the survey that you would like to discuss or highlight?
I know the headline of the report is increasing ESG and sustainability investing. The problem is that when you go down to the detail, cash investing in ESG, a large proportion of the companies just don't do it. It's increased enormously, but it's still a long way to go. The other factor that I found interesting is that 53% of the companies are not investing in ESG. And one of the biggest risks they found is greenwashing. Now, we just had a huge scandal coming out of Deutsche Bank, who promoted greenwashing the DWS, a German company. And these sorts of dangers are restricting the move to ESG investing, which I think is really important because we have to move to ESG and sustainability investing. So this trend here is so very important. But 10 years ago, when the ACT in the UK had one of their conferences and they had a session on ESG investing, only 3 people turned up for the session. A year later, the hall was booked out. So it's been a long progress. Long may it continue.
I mean, I think Jack's comment about it being a long process. I mean, there is a trend. It is towards more ESG, and it varies by region of the world. Environmental is definitely bigger in Europe and certainly in the UK. Governance is bigger in the US and North America. When you look at some of these numbers about somewhat important, very important, not important, I think it's vital to realize that there's a trend, a long secular trend in moving towards more of this activity, more ESG focus. And the other thing I found interesting is what are companies doing? Cash investing, that is a big area, 63% above supply chain management. And you would think perhaps supply chain management might be important. I suspect the cash investing piece is because that can be a little bit easier to implement. That was one thing I thought was quite interesting. One of the elements of financing that was quite interesting is the question was, which type of ESG compliant financing are you likely to enter into the next year? None was the majority, of course, but sustainability-linked loans was 19%, and we've interviewed companies that have done that. Provided both getting a better rate from their banks, and also there's a factor that goes to their suppliers. That's 19%. Green revolving credit facility at 16%. So we see some of these coming in, and it's hitting a notable percentage. Under 10% is really not notable, but when you get to the 15%, 20%, then you're seeing some progress. So this bears watching. I think the other piece too is the larger the company, the more they're talking about ESG. The smaller the companies aren't, and so this is really something I think worthy of watching. Not just the talk, but also who's talking about it, and then the actions. Where is that coming into play? So a lot of good information to keep up with there.
The third theme for today is cloud computing and security risk. The U.S. Treasury Department, in a recent report, the financial services sector's adoption of cloud services, found that while cloud services could aid financial institutions in becoming more robust, there were some significant obstacles such as financial firms' vulnerability to potential cyber attacks. The growth of the cloud marketplace represents a fundamental shift in security and risk management philosophy. However, embracing the cloud for financial institutions and corporations is not without potential headaches, as it also poses increased security risks along with the complexity of operating and managing multiple technologies. Craig, can you recommend an important step or measure that Treasury can adopt to make their cloud environments more secure?
That's a good and hard question. When you look at this this report, it's really talking about banks, and there's certain challenges that banks have that corporations don't have. And so I'll take your question to the corporation. I mean, the move to the cloud has been well established. It's almost universal. Back in 2000, somewhere around 2000, 2001, banks moved from private networks to the web, software and portals delivered over the web. That has rolled through almost every area of technology to the, what we would refer to as SaaS, as portal technology. That continues to expand with cloud native technology, things like Microsoft Azure, Cloud AWS, sort of more of microservices, the ability for this rapid development, greater scalability, and some of the newer technology and services that we're grown to expect, things like natural language search, the ability to make changes, let's say, in our cash position structure and have it roll back in history as opposed to a linear approach. It's more of a platform approach to this cloud native or platform as a service approach. Both of those together are making a big impact. So when you think about making investments in technology, corporations, Treasury are certainly saying, where can I invest where my product or my service will increase in value over time versus stay flat or decrease? And it's all SaaS and PaaS, software as a service, platform as a service. And security in those areas tends to be growing quite rapidly. It's quite strong. If we look at the early days of software as a service, the big complaint was that this can't be secure. Nobody's going to trust it. And I think that's been clearly proven not to be the issue. While there are always concerns about something new and not maybe something not established, some of these technologies have been around quite a while, are well established. So any Treasury group will be looking at cloud computing services as the default position as opposed to something that's in-house, installed, or on legacy technology. That has to be the default position. That has to be something very, very compelling to make a decision in a different direction.
Treasurers are in a difficult place here. As Craig pointed out, both the banks and corporations are moving to cloud computing and SaaS computing. The issue for the treasurer is which supplier, which user of these technologies would be best for me, best for my company. And that's a complex question, and the answers are complex. There isn't an easy way of doing this. It's finding the right advisors, I feel.
The fourth story that we'd like to discuss today is about central bank digital currency, or CBDC. 114 countries representing over 95% of global GDP are exploring a CBDC, and now the United Kingdom plans to launch a digital pound before the end of 2030, according to the UK Treasury and the Bank of England. Jack, what do you make of this announcement from the UK Treasury and the Bank of England to launch a digital pound before 2030? And do you think they're taking the time to investigate all angles before they launch a CBDC?
The answer to your last question is yes, there are privately behind closed doors, they're doing a lot of research about all different aspects, both from the corporate point of view, but also from the bank's point of view. But the Bank of England's attitude is summed up by Andrew Bailey, the head of the Bank of England. He describes it as a new way to pay, a way to help businesses have and maintain trust in money and protect financial stability. That's what they're looking at, because the examples of Bitcoin and other similar cryptocurrencies are really frightening the hell out of them. They need to bring stability into this market. They seriously think that this is the way to do it. I agree with them. The issue for corporate treasurers is cryptocurrencies are coming, and how are you going to handle them is the question for the corporate treasurer.
When I think about state-backed digital currency or central bank digital currency, this announcement is not interesting in one way, in that it's like, oh, this we're looking at doing this. It won't come before 2025. So it's it's a minimum of 2 years, maybe 3 or 4 years away. And so what's the reason for announcing this is, yes, we're thinking about it. We're a trusted party. We're going to do this carefully. It will take a really, really long time. And I think that's kind of one of the things that we find in the environment is the central banks tend to move very, very slowly, very cautiously. Same thing with banks. They move more slowly than fintechs. Fintechs move more rapidly. And so this idea that there's development in different areas and different levels of trust, and I would say stability, lends itself to, the ability to see where the future is going. Some will develop things much more rapidly. Some will be later to the game and may take over. So this is, I think some of that's defense. It's like, hey, we're going to do this. We're on the road. Maybe we can get everybody to wait. But it's also part of the different models. The most rapidly developing fintechs, a little slower follower on banks, and some other collaborations by banks, and then the central bank activity.
Yeah, one of the things that Bank of England are doing is interviewing very quietly. Bank of England tends to be very quiet in doing things, but they are quietly interviewing very big companies as to how they are progressing in the payment space and where Bitcoin or equivalent cryptocurrencies would fit. They need a stable and ready market when they launch theirs. This is a long-term marketing campaign. Have no doubt they're going to do it. It's just a matter of when, and we'll tell you slowly but surely what we're doing. So they don't lose confidence in it. They have confidence in the new currency that's coming.
Interesting. The fifth story for today is about Finzly, a US-based banking and payments fintech firm that will reportedly grant banks and fintechs access to the new fast payment platform FedNow via its API. FedNow, which was developed by the Federal Reserve Banks and is currently scheduled to go live between May and July 2023, is expected to offer secure and efficient real-time payment service. Craig, do you think Finzly's APIs and its direct connection to the FedNow service, as well as similar API offerings from competitors, will accelerate the adoption of instant payments?
Well, I think it's a necessity to have APIs support the new payment system, especially if we're talking about real-time or near real-time payments. If speed is one of the key components for using a real-time or faster payment scheme or system, you need to have a method of communicating those changes and the follow-up to match that type of speed. Certainly match the newer technology there. So I think this is an essential. What's the new technology footing, the new architecture? It's faster payments and faster connections. Now, not everybody needs instant, but nobody's moving slower, and they want that speed. So the idea of APIs versus file-based transfers is about innovation and reach. And then I think the other challenge here that I would think of, I'd love to hear Jack's comments on, is you can have all the fast connections into faster payment systems and platforms. You have to manage it on the back end, and the faster things are, the more rapidly you have to do things like reconcile, cash position, settle, resolve. Those are about efficiency and straight-through processing. And I would say that the back-end systems of many companies lag. They don't offer streaming, or many companies don't have API gateways they can connect all this information to and take advantage of it. So it's kind of like multiple speeds, like slow, and then I connect with an API really quick, and then there's batch or day of transaction. So the idea is this has to speed up, and I would relate it to has to speed up in the back end. I would relate this to when we had EBAM came out, and it was like, oh, we can have all these digital conversations with our banks about adding signers, accounts, etc. And everyone loved the idea, and then we're talking about the banks. The banks don't have everything connected in the back office, but the reality was people were managing their accounts on Excel files and paper-based systems. So their conversation wasn't going to start out that way. Only a small percentage of companies had something that could manage it. And so the growth and the real benefit of this will be as we can go more end-to-end faster with APIs, whether you need the funds to move in 2 minutes or 2 hours or 2 days. tends to be secondary to having the ability and speed here. That's a bigger story than a particular vendor offering APIs. That will become table stakes, in the digital world. Happy to see it, but it isn't going to be my top story.
For me, the key piece that was in this article was how they're considering, and this is the FedNow whole concept, they're considering the real-time or near real-time or much faster, the number of different areas it's going to connect to: instant payments or return of funds, insurance payments, government benefits, healthcare payments, online, etc., etc. And with that scale of investment in and infrastructure that is going to be faster or pseudo real time, the back office in corporate treasuries becomes even more important. And this is where I think the big drag is going to come from, is the pressure on both the banks and the corporates to get their back office behind the scenes systems working in the same way. It's going to take a lot longer than, 2030 comes to mind before we're going to see reality of quite a bit of this. But the concept is huge.
Before we end this episode of the Open Treasury podcast, I'd like to know, what is your choice for the biggest or most important story of the past week and why? Jack, if I can ask you, I can request you to answer that first.
Yeah, I thought there were three different things that come together. Corporate Treasury needs to keep abreast of the overall business trends and opportunities so they can invest even if the company doesn't normally do that, and they need to be more aware of that rather than less aware of that, of the opportunities in any recession as we're going through now. The second is that they need to ensure they're ready for the real-time world, the internet way of working. And the final thing is they have to start preparing for the accounting and the system stresses from getting into cryptocurrencies, because if Bank of England are talking about it, it's definitely coming, and it's going to come worldwide. So they've got three pressures all at the same time, each of which are just as important. You can't just deal with one. You have to deal with all three.
I'm not going to pick any of these individual articles. I would say some of the biggest stories of the last week or so have to do with, one, the announcement by the Biden administration of releasing another, I think, close to 30 million barrels from the strategic petroleum reserves, which were already at the lowest level in 40 years, and they're releasing another 30. And this is really geared towards keeping the prices low. So that's a indication of, I think, concern that prices are going up, but it also tends to impede the bringing online more production, which makes things harder down the road, unless there's something drastic, like let's say a global recession that reduces the demand on a global basis. That's one of them. I think the second thing that seems to be occupying the news a lot are all these balloons flying over Canada and the U.S. on a spy level. Obviously they're not weather balloons. That's creating some agitation and concerns across the board. So I guess I would say those as two, geopolitical and macroeconomic changes that are being put in place that could have a bigger impact on Treasury, with perhaps a deeper recession if there's a recession, as well as some concerns on the trade front. But those are the bigger stories in my mind for the week.
Those are wise words, and I hope our audience is listening to what Jack and Craig recommended. Thank you so much, Jack and Craig, for your valuable insights. We would also like to thank our CTMfile audience for joining us in this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.